Something strange is happening in the Bitcoin market right now. And I'm not talking about the price action you see on your screen every day. While everyone's panicking about corrections and calling for crashes, there's a hidden mechanism quietly building pressure beneath the surface, a trigger that's been ignored by 99% of crypto traders. This isn't about some new indicator or chart pattern. This is about a fundamental force that's been responsible for every major Bitcoin explosion in history. And right now, it's coiling like a spring ready to snap. By the end of this video, you'll understand exactly what this trigger is, why the institutions are positioning for it, and most importantly, when it's likely to fire. But here's the thing, if you want to stay ahead of the next major move, hit that subscribe button now, and you can unsubscribe anytime. Now let's dive in. Let me ask you something. When you look at Bitcoin's price, what do you think actually moves it? Most people will say supply and demand, whales, news events, technical levels, and sure, those matter on a day-to-day basis, but they're not the engine. The real driver, the force that creates those massive 300%, 500%, even 1000% bull runs, is something called global liquidity. Think of global liquidity as the total amount of money sloshing around the financial system. When central banks print money, when interest rates drop, when credit expands, liquidity increases. And when liquidity increases, that money needs somewhere to go. Here's the fascinating part. Bitcoin doesn't just correlate with liquidity, it amplifies it. When global liquidity rises by 10%, Bitcoin historically rises by 30%, 50%, sometimes even 100%. It's the ultimate leverage play on the world's money supply. And right now, after months of consolidation and fear, the liquidity machine is starting to wake up again. Let me show you the data that Wall Street doesn't want you to see. The M2 money supply, the broadest measure of money in circulation, contracted for the first time in decades during 2022 and 2023. That's why Bitcoin crashed. That's why altcoins got massacred. The money literally disappeared from the system. But something changed in late 2024. Central banks globally have begun easing again. The money printer didn't just turn back on, it's accelerating. The Federal Reserve has pivoted from hiking to cutting rates. The European Central Bank is easing. China is injecting stimulus. Japan is maintaining its ultra-loose policy. Even smaller central banks are joining the party. When you add it all up, we're looking at the largest coordinated liquidity injection since 2020. And we all remember what happened to Bitcoin in 2020, don't we? From $10,000 to $69,000 in less than a year. But here's where it gets really interesting. Every major Bitcoin bull run follows the same three-stage pattern driven by liquidity. Understanding where we are in this cycle is the difference between buying the top and catching the bottom. Stage 1, the stabilization. This is where we are right now. Liquidity has stopped contracting and starts to stabilize. Bitcoin bounces off its lows, consolidates, and builds a base. Volume is low, sentiment is terrible. Everyone who got wrecked is still in disbelief. The charts look boring. This stage can last 3 to 6 months. It's where smart money accumulates quietly while retail throws in the towel. Look at these three periods: early 2019, mid 2016, and late 2023. All of them looked dead. All of them saw massive capitulation events right before the turn. And all of them were sitting on top of expanding liquidity that hadn't reached the market yet. Stage 2, the breakout. This happens when liquidity reaches a critical threshold and suddenly floods into risk assets. Bitcoin breaks key resistance levels. Exchange-traded fund inflows accelerate. Institutional buyers who were waiting for confirmation all rush in at once. The moves are violent. 30% gains in a week become normal. Altcoins start waking up. Retail FOMO begins building. This stage typically lasts 6 to 12 months and sees Bitcoin appreciate 200% to 400% from its cycle lows. Stage 3, the euphoria. This is the final stage, the blow off top. Liquidity peaks. Everyone from your Uber driver to your grandmother is talking about crypto. Bitcoin is on the news every night. Prices go parabolic, making gains that seem impossible. This stage is short, usually 2 to 4 months. But this is where life-changing returns happen. Bitcoin can double or triple in this phase alone. The question everyone's asking, which stage are we in right now? Based on current liquidity data, we're transitioning from stage 1 to stage 2. The stabilization is complete. The breakout is beginning. But there's a specific indicator that tells us exactly when stage 2 truly begins. And that's what most traders are completely missing. Here's something that might blow your mind. There's a publicly available indicator that has predicted every single Bitcoin bull run with scary accuracy. It's called M2 Global Liquidity, and it measures the combined money supply of the world's major economies: United States, Europe, China, and Japan. When you overlay Bitcoin's price with M2 Global Liquidity on a chart with a 6-month lead, the correlation is almost perfect. In 2016, M2 Global Liquidity turned up 6 months before Bitcoin began its massive rally from $600 to $20,000. In 2020, M2 exploded due to pandemic stimulus, and 6 months later, Bitcoin went from $10,000 to $69,000. In 2022, M2 contracted sharply, and 6 months later, Bitcoin collapsed from $48,000 to $16,000. Seeing the pattern? Now here's the critical part. M2 global liquidity bottomed in October 2023 and has been rising steadily since then. That means the 6-month lag effect is already underway, and we're entering the prime window for Bitcoin's next major expansion phase. But it's not just about M2. There are 3 other liquidity factors converging right now that create a perfect storm. Factor 1, interest rate cuts. Lower rates mean cheaper borrowing costs. Companies and individuals take on more debt, which creates new money. That money flows into assets. The Fed has already begun cutting, and markets are pricing in several more cuts through 2025. Each cut injects liquidity. Factor 2, the US dollar weakening. A weaker dollar makes Bitcoin more attractive as an alternative store of value. It also means foreign investors can buy more Bitcoin with their local currencies. The dollar index has been rolling over since its 2023 peak, and technical indicators suggest more downside ahead. Factor 3, bank reserve depletion. This is technical, but crucial. The Fed's reverse repo facility, which sucked liquidity out of the system, has fallen from $2.5 trillion to under $200 billion. That money is now flowing back into the financial system, adding fuel to the fire. When you combine expanding M2, falling rates, a weakening dollar, and depleting reverse repos, you get a liquidity tsunami. And Bitcoin is sitting right in its path. But timing is everything. So when does this trigger actually fire? Based on historical liquidity cycles and current data, here's how the next 12 months could unfold. Bitcoin continues consolidating between key support and resistance levels. Liquidity is rising, but hasn't reached critical mass yet. Sentiment remains cautiously pessimistic. This is the final accumulation phase before the breakout. The people who are DCAing during this window will be rewarded. The acceleration. M2, liquidity reaches the tipping point. Bitcoin breaks through resistance decisively. Institutional buying accelerates. Exchange-traded fund inflows hit new records. Bitcoin reclaims its all-time high and pushes beyond it. We could see $100,000 to $120,000 during this phase. After the initial surge, Bitcoin takes a breather. Profit-taking occurs. Altcoins begin rotating. This is the mid-cycle pause that shakes out weak hands before the final leg. October 2025 to March 2026. The euphoria. Liquidity peaks. Bitcoin enters its parabolic blow-off top phase. Mainstream media coverage explodes. Retail FOMO reaches maximum levels. This is where Bitcoin could push to $150,000, $200,000, or even higher depending on how extreme the liquidity injection becomes. Now let me be crystal clear. This is not financial advice. This is a scenario based on historical patterns and current liquidity data. Markets can and do behave unpredictably, but if you understand the liquidity cycle, you understand the game. And right now, the game is just beginning. The institutions know this. The smart money knows this. And now you know this too. So what should you actually do with this information? First, stop obsessing over daily price movements. If the macro liquidity cycle is in your favor, short-term noise doesn't matter. Zoom out. Second, if you believe in this thesis, this consolidation phase is your opportunity. Whether that means dollar cost averaging, building positions during dips, or simply holding what you already have, patience is the play right now. Third, stay informed. Liquidity conditions can change. Central bank policies can shift. The key is monitoring the data, not just the price. The trigger is loading. The liquidity machine is waking up. And the next explosion could be bigger than anyone expects. The question is, will you be positioned for it, or will you be one of those people who panic sold right before the launch? Thanks for watching. If you found this valuable, smash that like button and subscribe for more deep dives like this. I'll see you in the next one.